Hey Bowtie Nation, Joseph Hogue here, coming to you for another one of our Monday market updates, 9 a.m. Eastern, in the new studio. Not quite set up yet. We don't even have internet in here, so that's why I'm recording. We won't be live for another couple of weeks, but I wanted to get to you this week because we have a very important topic this week. Everybody tells me I should be more optimistic, right? It's a comment I get all the time, especially over the past few months when I've been arguing that this recent run-up in stocks was just a bear market rally, right? The Fed is just getting started with its rate hikes. Inflation is not easing up, and the jobs market isn't making it any easier. So this, rather than a sustained bull market, I've been arguing that you need to take advantage of those highs in prices, of that rebound in prices, to take some money off the table and protect yourself. And we have seen stocks come down about 8 to 10% from that rally. NASDAQ obviously getting hit even harder. And there might be more pain ahead. But it is hard to be, pessimistic because nobody likes a negative Nancy, right? On Wall Street, when I was working as an equity analyst, you can lose your job if you're negative, if you're pessimistic on stocks and wrong, right? If you're saying that stocks might go down, they go up, you lose your job, you're out on your ass. But if you're optimistic all the time, if you're a perma bull saying buy the dip, keep on investing, and you're wrong, then nothing happens because you're wrong with the crowd, because everybody else was wrong as well. So it's really hard to be negative. And, in that turn to try to be a little bit more optimistic for you, then this week I wanted to cover stocks that are still up, this year, even in that stock market sell-off, even in that broader bear market. Stocks, groups, and sectors that are still doing well that you can look to for protection in your money. After that, though, stick around because we'll have our Monday market updates with all the stocks I'm watching, the news that's going to guide this week, and everything you need to know to get ready. Next week's probably going to be another recorded market update with you because we won't have internet yet. I won't have my studio ready for you yet, but I promise we're going to get back to our live streams Monday mornings at 9 a.m., answering all your questions. I really love connecting with you on a face-to-face level there. On the upside, though, with the green walls here, there are a lot of fun things we can do with the studio right now, like this. Maybe this is a little bit more style, but right now we're just going to keep it green and see what happens. Before we get started, I do want to highlight a special offer that just came through to the Bowtie Nation. A lot of you know that I started writing on Seeking Alpha back in 2009, 2010, even before I started working as an equity analyst, before I joined a venture capital firm, before I started working private wealth management. I was writing on Seeking Alpha. Here's some of my articles here: 2011, 2012, working for a company called Emerging Money. It was led by Tim Seymour over there at CNBC, writing a lot of their emerging market analysis, Argentina, Latin America, Colombia, stocks in those regions. So I was surprised when an old editor friend out there reached out for a special offer to everyone out there in the Bowtie Nation: $99 for their annual premium package. That's 60% off from the $239 they usually offer it for. You can get it down to $120, $140. That's what I've been paying the last couple of years, $120 a year. A lot of great features here. $99 with the link I'll leave in the description below. The only way you get that for $99 is through this link. Some great features there. The limited access, the basic pass, which is free. You get some analysis, really hit or miss as far as the analysis and the articles there. But you get into the premium package, you get a lot better quality analysis, and you get a lot of these other features that I like. The ratings tool, the ratings screener, you can screen for a lot of those. You can get dividend forecasts, so a lot of the forecasts for dividend growth on a lot of your favorite dividend stocks. You get that with the premium package. A lot of great features. So click through that, try out the free trial, and if you like it, $99 for the year, the annual package. That's 60% off. You save $140 with that link. I want to get to those stocks that are actually up during the stock market crash, because it has been a crazy couple of months with stocks surging 18% off that June low in that bear market rally, right? Only to crash 8% over the last few weeks. And again, I don't believe that sell-off is over. The Fed is just starting its rate hikes. And so I believe, if you didn't take profits in that bear market rally, kind of take some money off the table, then you could be in for more pain over the next weeks or months. But these stocks, believe it or not, this is typical in earnings season with so much uncertainty around the market's direction. It seems daily that we see stocks plunging double digits while others will boom 10% higher. And it's all because, the market is looking for some kind of a direction and punishing those stocks that underperform or miss their earnings expectations while rewarding those that beat. And while might seem random or chaotic, stepping back to see this bigger picture that I'm going to show you right now, see which sectors, which industries, and even which specific stocks are outperforming is going to help you show you where to invest, how to protect your money, and how to keep making money instead of losing it in this stock market crash. So what I did, I dug into the most recent FactSet earnings insight. I'm going to share that with you here. All of you know this is one of my favorite research tools. You go on Google, you search for FactSet Earnings Insight. It's a weekly research report, totally free on the internet there, done by FactSet. They survey analysts on Wall Street, S&P 500 companies as far as earnings expectations. Just a really great research tool. And I looked on here. First, I want to share with you the number of S&P companies with fiscal year positive and negative guidance. Now, what this is showing us here, these by sector here for fiscal year 2022, 2023, this year and next, how many companies in each sector are warning about negative earnings estimates and or maybe guiding up to positive earnings surprises, right? So the red is how many companies in each sector are coming out and saying, hey, times are tough, inflation is really eating into our profits, and we might not be able to meet those earnings expectations set on Wall Street. The green, though, is positive earnings, companies with positive earnings expectations. So it's really kind of a great guide to which sectors are most positive over the next year and which are most negative. Here on the left, all the way on the left, you can see healthcare, utilities, industrials, all three leading with the highest number of negative guidance, companies coming out with negative earnings. Now, what's more important probably, though, is just kind of the spread between negative and positive guidance, right? So, you've got healthcare, you've got 25 companies there coming out with negative earnings, but you've also got, or negative guidance, but you've also got 23 companies coming out with positive guidance. So it's really much more balanced. Whereas in utilities here, the utility sector, so companies in the utility sector, electric and gas companies, that kind of thing, coming out 21 companies coming out with negative guidance and only 6 with positive guidance. So management in that sector, management in the utilities companies, very much more negative than the rest of the market. With industrials, you also have that kind of balance, 21 to 20. Consumer discretionary, much more pessimistic here, 16 companies versus 11 companies with positive guidance there. So it's much more pessimistic in consumer discretionary. Information technology, this one was kind of surprising because 20 companies have come out with positive guidance, positive forward guidance, saying, hey, I know everybody's talking about the inflation, everybody's talking about those lower margins, but we're actually doing pretty good, and we're going to increase our estimates, increase our earnings guidance for the next year. So you had 20 companies doing something like that, 14 companies coming out negative. So much more positive as an overall trend in the technology space. You can see some of these other ones. Pretty well balanced here in consumer staples, 5 to 2 here in financials. Real estate, another very surprising one. 17 companies coming out with positive guidance against just 5 coming out with negative guidance. So very much more positive in the real estate space. And this is interesting because real estate and real estate stocks, those REITs, are down about 12 to 15% so far as a sector so far this year. And we'll look at that sector here in a minute. But they're down to valuation territories, and management's coming out pretty positive. So that might be something to look at, here over the next year. Now, besides that forward guidance, so how optimistic or pessimistic management is for the next few quarters, I also wanted to look at how they actually did over the last quarter, right? So we just wrapped up second quarter earnings season. All those companies came out and either met or exceeded or failed to meet those expectations. So I wanted to see which sectors and which companies were really outperformed in the last one. This is a chart of the S&P 500 earnings, the percentage of companies that were above estimates, that were above expectations, that met expectations or actually missed those expectations. And here in the middle, you can see with the S&P 500, 75% of the companies in the S&P 500, so that broad stock market index, 500 largest companies in the United States, 75% of them beat those expectations. They came out with earnings that were above expectations, which is pretty well normal. Most companies in that earnings game, it is a game. Management tries to guide expectations lower so they can be easily beatable when they do come out with their earnings. So generally, you do have well over 70, even 80% of companies beating their earnings estimates. So that's not so much of a surprise. 21 companies did come out and miss their earnings expectations. That is actually a little higher than normal. So it really kind of speaks to the way inflation is driving those profit margins lower, that so many companies are missing their earnings expectations. But that's the S&P 500. That is the market as a whole. 75% beat expectations, 21% came in below expectations, and 5 came in right at expectations. And we can look here to see which sectors, the companies in which sectors really outperformed. We had 90% of the companies in the energy sector. So all those energy stocks, those energy companies, 90% of them beat expectations. And of course, that is on the very strong oil and gas prices that we've had since Russia invaded Ukraine back in February. So throughout the second quarter, energy prices, oil was extremely high, and those energy companies are doing very well. I expect that to continue. Again, something we've talked about over the past couple of months here is Russia and President Putin have no pressure really to negotiate or to start negotiations until well into the winter. Okay, that is when their bargaining card is at its highest because of the amount of oil and gas that flows through from Russia into Europe. Their bargaining chip is going to be the highest when the Europeans need that oil and natural gas the most, which is obviously at the height of the winter. So I don't expect Russia to even start negotiating any kind of a deal on Ukraine until at least into January or February. That means for the next few months at least, oil is going to be strong, oil is going to be high, and a lot of these energy companies are still going to be very profitable, very high cash flows there, and doing well. Information technology. It's kind of surprising here with as hard as IT and tech stocks have been hit in the sell-off, and so far this year, 87% of those companies actually beat earnings estimates. 13% came in below. After that, you've got healthcare, industrials, and real estate, all with 80% of the companies in those three sectors beating estimates. So again, we see real estate here. We talked about that just a minute ago. Real estate, 80% of those companies beating their earnings estimates. Management coming out extremely positive with positive guidance. That is definitely, I think, one to watch, especially if you're worried about inflation. You're worried about inflation hitting your stocks, then real estate is going to be something that holds up well in that inflation. We can look on the right here to see the reverse of this. Communication services, worst sector here, 50%, just half of the companies in the communication services sector beat expectations, with 45%, almost half, missing expectations. And of course, this was a lot of those internet stocks, a lot of the social media stocks that have seen advertising revenue just fall apart over the last 3 months. And I expect that to also continue. Just anecdotally looking over, my own YouTube revenue, my own YouTube ad revenue, talking to other YouTubers and other influencers about their ad revenue, those ad rates are continuing to go down. Companies are pulling back on that ad spending. That's the first thing to go in a recession before companies even start laying off and laying off workers, is they cut back on those marketing expenses, that ad revenue and that kind of thing. And we've seen that over the past 3 months. We'll probably see it over the next 6 months at least. That ad revenue will continue to go down, and that's going to hit a lot of those companies that are based on that kind of business model. The internet companies, the social media stocks, the social media companies that really live or die on that ad revenue. Financials also, 63% beat earnings estimates, but 37% of the companies in that sector missed their earnings. Now, I still like the financials. I still like those bank stocks because I think a lot of what we saw in the second quarter was just kind of a little bit of financial magic, right? Accounting shenanigans, where they took the money off of their earnings, off of their income statement, and put it on their balance sheet as a loan loss reserve. So we've talked about this in the past. It's something to watch for in these bank stocks. They always take money out of their earnings. That lowers their earnings. That makes profits look so much worse. But that money is still there. And eventually, when they decide to bring it back out of those reserves, that what-if account on the balance sheet, that is going to boost earnings. That's what we saw during the pandemic, and I believe it's what we're going to see over the next year as well. Besides that, the financials, they do very well with rising interest rates, that net interest margin that they earn by taking your money, giving you very low rates on those short-term loan rates. or those short-term deposit rates, and then lending that out to 10 and 15 and 30-year mortgages, they make a lot more money when those interest rates increase. And I think that's what we're going to see here over the next year. As interest rates increase, the financials are going to do well. So I think a lot of the financials, a lot of the bank stocks coming into value territory, and something you want to watch here. Now, using the sector tracker tool here on sectorspider.com. Again, all of you out there in the nation know this is another one of my favorite resource items, totally free to use. It's the sectorspider.com, the sector tracker. You go to tools here, you go down to sector tracker, and this is going to show you what these sectors did, all the stocks in each sector, 11 sectors of the S&P 500, the largest 500 companies there in the United States, and how they did over these different time periods. It's a great way to get that higher level view of what those sectors are doing before you narrow it down into specific stocks to buy. So here over the last month, as stocks have come back off of that bear market rally, we still have stocks in the energy sector up 4%. In fact, utilities just barely holding on with a 0.97% gain. The rest of the market, the other 9 sectors in the S&P 500 are down, some pretty heavily. Technology stocks down 7%. Real estate down 4.8%. Communication services down 4.2%. And again, if you look at that real estate, a lot of this is just the increase in interest rates, right? The 10-year treasury fell. The 10-year treasury rate fell to something like 2.6% over the last couple of weeks, but is now back up over 3%. And a lot of these interest rate sensitive stocks, like financials, like real estate, have really taken it because they're very much, interest rate sensitive sectors. Real estate, obviously, as interest rates go up, it gets harder and more expensive to borrow to finance those real estate transactions. So that's why real estate has sold off here. But again, I do like the optimism from management in that sector. They have done very well as far as earnings over the last quarter, and I think that's one you want to watch. Those traditional safety sectors like utilities, like consumer staples, down 3%, which is still down but beating the market. You've got those traditional safety stocks that should continue to do well. All these other sectors are down an average of 4% or more, with the S&P down about 4.1% over the period. If you look here into on the right here, you can always change this to see which stocks, specific stocks, are up or down. If we went through here, we'd see 148 of the 500 stocks in the S&P 500. About one in 3 stocks are actually up over the last month, so beating the market by at least 4% or more. Some of them notably so. Constellation Energy here up 23% over the last month, so beating the market by about 27%. But some other notables, Cardinal Health is up 18%. Principal Financial Group up 11%. Headquartered there in my hometown in Des Moines, Iowa. Progressive Insurance up 9%. Gilead up 9%. Ross Stores up 8%. And if you look through some of these, it's not only a way of picking out the ones that have outperformed, but getting a sense of the themes and the trends in these. You see a lot of healthcare stocks, right? Even though healthcare is down 4.5% over the past month, that's skewed by a lot of those biotech, a lot of those riskier biotech stocks. If you look deeper into the industries within healthcare, you see a lot of these stocks, like the distribution stocks, like the drug makers, are actually doing very well. And that's what you often see in a recession or leading into a recession, is the drug makers do well because of those stable cash flows. Principal Financial Group, Progressive, insurance companies also doing well. Gilead Sciences, like we talked about, those drug makers, and Ross Stores, the discount stores, also hold up during a recession because as people pull back on their spending, they go to where they get more bang for their buck, right? They go to the discount stores, the dollar stores, and those generally do very well. So again, here I do expect the energy stocks to continue to outperform, to continue to churn out that cash flow on those high oil prices and those dividends. The financials, I think, is a great turnaround play here. Utilities and consumer staples, obviously, as traditional safety sectors, will hold up pretty well. Stocks in the communication services sector, especially those internet and social media companies, probably continuing to feel the heat on that slowdown in advertising just as the economy weakens and really proves that recession story. Most of these stocks, though, are setting up to be very strong buys on valuation. Social media, if you think about social media, you think about Facebook, YouTube, a lot of those social media platforms, they may be making less money, but are you really using them any less frequently? I know I'm not. I know I'm still addicted to some of these social platforms, especially YouTube, obviously, and will continue to use them. So that just means that when those ad rates do start to increase yet again, we are going to see higher earnings on those companies, and we're going to see those valuations pop up back again. So I'd be watching those probably here in the next quarter, not immediately, but here in the next 3 to 6 months, I'd start adding those in, adding those into your portfolio on those valuations. Here, I want to turn it over to our weekly market update. Again, 9 a.m. Eastern every Monday morning, getting you ready for the week with all the stocks I'm watching, the economic news coming out that's going to guide the week, and really just what you need to know to get started on your week. Some stocks I'm watching this week: UiPath, ticker PATH, going to report its earnings on Tuesday with very low expectations on this one. Expectations for a loss of 11 cents a share. That would be well under the what it reported last year. Company has beaten estimates in the last 4 consecutive quarters and should be able to do it easily this year or this quarter for the second quarter. Full year expectations are still for 22% sales growth, so very strong sales growth to a $1.1 billion and a loss of 1 cent a share. Shares are down 80% from last year's IPO, but still pretty expensive, 9.3 times sales. I like the long-term outlook on this one. It's a robotic process automation provider, so very strong growth industry. But shares are still going to be susceptible to that valuation sell-off for as long as they're this richly valued. If investor sentiment remains negative, it's going to pull all those growth stocks down with it, no matter how good the earnings. So I would watch this one, but if you really want to invest in this one, maybe take a small position before earnings, maybe a quarter. If you have $100 to spend on it, maybe buy $25 worth, then go in for 25 or 35 after the earnings, and hold some more for the next 3 to 6 months, because I do think we get better prices here on a lot of these growth stocks like UiPath. Academy Sports and Outdoors, ticker ASO. It's going to report its earnings Wednesday with expectations for just $2.08 per share. That's versus $2.34 in earnings for the same quarter of last year. So lower earnings. Should have no trouble beating its estimates. It's been able to do that quite consistently in the past. Full year sales are expected lower by 2.7%, which is kind of odd given the ability so far for most retailers to really post those strong sales growth due to inflation and higher prices, right? What we've seen with most retailers so far is that they are increasing their prices and increasing their prices enough that they're posting sales growth. Okay, they're actually growing their sales on a year-over-year basis. They're reporting lower earnings though, because they're not able to pass on all the inflation that they're paying on to customers. So we're seeing high sales growth, lower earnings growth, and sometimes even negative earnings growth. With Academy Sports though, not being able to pass on, or maybe choosing not to pass on those higher costs to customers, and actually expected to post negative sales growth of 2.7%. I would think that's probably pretty easily beatable though, and that they'll actually post some sales growth this year. Shares trade for about 0.61 times sales, which isn't really cheap for a retailer, right? Most retailers you'll see will trade for 0.5 times sales or somewhere around there, but it's still lower than competitor Dick's Sporting Goods at 0.96 times sales. So this part of retail has actually been fairly strong. Through the pandemic, people couldn't go in crowded places. So instead, they chose to buy outdoors and sporting equipments and go out hiking and things like that. So Dick's Sporting Goods, Academy Sports, and Outdoors did really well. Shares are actually up 12% so far, beating the market since adding them to Chad's $1,000 stock portfolio challenge. About a month ago, I got 5 members of the Bowtie Nation to pick their 5 favorite stocks for the rest of the year. The top portfolio is going to get that $1,000 or whatever it is at the end of the year and win that money. And Chad put those in there, up 12%, beating the market by about 12% over the past month. So definitely one to watch. GameStop, ticker GME, is going to take that spotlight with its earnings Wednesday, expected to post a loss of 38 cents a share versus a loss of 19 cents a share in the same quarter last year. So still very much deep in the red for this company. Full year sales are expected up 7%. So like a lot of those other retail companies, being able to post some just a really strong sales growth as they raise prices. But earnings are still expected to be deep in the red here with a loss of 92 cents a share. Okay, shares have found support this year right around $20 each, but right now trading at 27, so there could be more downside, especially on that weakened investor sentiment. Still relatively expensive at 1.47 times sales. So for a retailer, 1.5 times sales is pretty expensive on a valuation basis. Obviously, this one gets a boost from those meme stock traders and so some of the interest there. Downward market direction, though, it probably is going to weigh on those meme stocks. DocuSign, ticker DOCO, one that we've been watching here on the channel as a great long-term growth story, reporting its earnings Thursday, expected to have earned 42 cents a share versus 47 cents a share in the same quarter of last year. So this is actually one of those growth companies that is profitable. Okay, it is making money right now. Shares are now down 82% from last year's peak and down to 5.2 times on that price to sales basis. So no longer trading in those nosebleed stratosphere as far as valuation. I actually own shares of DocuSign myself. Not saying that it couldn't continue to come down, because we have seen all those growth stocks continue to sell off. But this is one of those growth themes. They are just moving into a lot of the other virtual signing things and other revenue streams. I really like this one for that long term, even if it's still about 5.2 times sales. It's not the cheapest of the growth stocks I follow, but it is definitely in that buy territory for a company maintaining 20% annual sales growth. Another one here we've followed on the channel before, Zscaler, ticker ZC, expected to report its earnings 20 cents a share on Thursday, 42% higher from the same quarter last year. Full year earnings here are expected 53% higher on 41% sales growth, and management has done really well beating expectations in the past. I actually recommended Zscaler back in 2019 when it was at $50 a share, and it's an excellent, well-run company, a unique advantage in its industry, in that security industry, really moving security services into the cloud services. But it's just really hard. I haven't been able to recommend it over the past couple of years, over the past year, on this valuation. Despite that runaway growth and the drop from the highs of last year, it's too difficult for me to recommend anything trading at 23 times on a price to sales basis. So this is one of them I would watch. It could explode higher. It is a great company, very well run, and just seeing some great sales growth and earnings growth. But by that same token, it is still just way too expensive for an old value investor like myself. So I'm continuing to watch it. If it gets back down into 10 to 15 times price to sales territory, I might start buying into it again, and definitely down. If it ever gets down below 10 times on a price to sales basis, I'll add more shares there. As for how the sectors did last week, all 11 stock sectors closed lower again last week, though those traditional safety sectors did fulfill their role to kind of protect investors on a relative basis. Okay, we saw utilities down just 1.5%. Consumer staples down 2.5% against the overall market down 3.3%. Some of these other sectors here, healthcare was down just 1.8%. So obviously a lot of those biotech and riskier healthcare companies underperformed, but you still had enough of those healthcare services as well as the drug makers holding that sector up. So healthcare did outperform 1.8% down versus 3.3% for the overall market. Energy stocks in the energy sector got slammed last week on a drop in oil prices. Oil down by about 6 to 8% last week, but oil has found the bottom. I think down right around there, $85 a barrel. That actually presents a good buying opportunity for energy stocks. Again, I think energy prices are going to continue to stay high, especially as we get deeper into the winter, and those stocks are still going to cash flow. Again, financials have sold off on recession fears, but investors seem to be kind of overlooking the fact that higher rates are going to benefit these companies in the sector. So I think that is another buying opportunity in these sectors, those financials and those bank stocks. Individual companies continue to present the best opportunities, though. Something we talked about there in that opportunity, or in that main topic there. Strong earnings seem to trump that downward trend. A lot of stocks getting a boost as they meet or beat expectations, as well as those stocks that fall short of expectations and falling hard. So while stocks in the consumer discretionary sector have fallen on average, You got others, shares of Bed Bath & Beyond and Ulta Beauty, both finished in the top 5 stocks in the past week with very strong gains of 2.8% for Ulta Beauty, 4.4% for Bed Bath & Body Works. So it is not that you can't find good stocks in some of these beaten down sectors if they come out and beat earnings. It is a holiday shortened week this week with no real data to turn the markets. So I do think that downward bias for investors is going to continue really until we get that CPI, that Consumer Price Index of inflation, reporting out in the following week. The ISM Services report is released on Tuesday. Economists are expecting a little bit lower reading, but still in growth territory. But that's probably not going to be enough to really sway the markets into an upward trend. Lately, it's been a lot of the presidents of the Fed coming out and talking, those speeches that have moved the markets. We've only got one of those this week with Cleveland Fed President Mester. She has been hawkish along with the rest of the Fed presidents lately, really trying to talk the market out of that idea that the Fed is anywhere near its pause or time where it's going to be on hold on interest rates, right? So she's likely to say nothing new this week when she talks on Wednesday, I believe. She's going to be hawkish. She's going to say that the Fed is certainly committed on bringing down inflation, raising interest rates as high as those need to be until inflation does come down. So not likely to help the markets, and I think that downward trend is probably still intact. Don't forget to check out that special offer for premium access to Seeking Alpha. More than 60% off. Save $140 on their annual package. I use the service myself. Or click on the video to the right for the one index fund you need to buy.